Good afternoon, everyone, and thanks for tuning in to today's first IEEE USA Career Webinar of 2023, Investing Basics, 5 Steps to Building a Disciplined Investment Strategy. I'm your host, Jonathan Cho. This is the first financial literacy webinar. This is the first in our financial literacy webinar series in partnership with IEEE member discounts. For more information on our upcoming ones, you can check them out through the link we provided on the screen below, as well as in the comment section. IEEE USA's goal is to create programming that is valuable, relevant, and of interest to you. As such, we will be sending a short survey to all registrants after this event and would love your feedback. We value your opinions and would appreciate it if you could take a few minutes to share your thoughts. Joining us today is Kyle Cunningham from Northwestern Mutual Wealth Management Company. Kyle is a wealth management advisor specializing in personal wealth management and retirement income planning. Kyle has been in practice for 14 years and helps clients build and protect wealth using tax advantage investment and financial planning strategies, and is a wealth management and retirement income certified professional. Without further ado, I'll now pass it off to our presenter. Welcome, Kyle. We're very excited for what you have for our audience today.
Thank you kindly for the introduction. It's my pleasure to be here with you all. And we're here to discuss a very exciting topic, one that is very relevant for all folks in any discipline, in any industry. What I can say as an opener is many of my clients are engineers and architects, and in 14 years of helping clients build wealth on a tax advantaged basis, I know the importance of this topic. It's really one of the backbones toward any individual or family or even institution meeting their objectives. So investing is so crucial, particularly doing so on a strategic basis in today's volatile world. So I will suggest I am very happy to connect here today, and I'm excited about the prospect of helping each of you feel a bit more confident in your own unique investment plan. There are some truisms, some principles to investing, and it's the case we're going to address those today. We're going to speak to the sound, fundamental elements of a good, successful investment portfolio. It's really not that complicated. When we break it down, it's really all about some factors that we can control. It feels often like the investments and the outcomes are out of our control, and to an extent they are. But when we control the controllables, we can meaningfully impact the outcome. And my hope is that you all enjoy very successful investing on your end. It's very complex, right? The stock market, there's all different types of products and hundreds of firms, and it's really challenging to make sense of it all. It could leave your head spinning. The market seems like it can be flying high forever. We just finished up a 10+ year bull market, but then all of a sudden there can be a drop and everyone's running for cover. Well, conventional wisdom tells us that what goes up must come down. And when you think about market volatility, volatility is a normal occurrence, but it can be tough to handle when it's your own money at stake. So I'm glad you're here today. My goal is to help you answer a question that's on the mind of so many investors. How can I personally feel more confident in my own strategy in today's changing world? I'm going to help you get a handle on the fundamentals, core strategies that institutional and individual investors rely upon to help them navigate the often choppy waters of investing. I'll share with you 5 strategies that can change how you view the markets and help you become more confident as an investor, regardless of the market direction. So first, you'll see why a sound investment strategy starts with your end goal in mind. Then I'll explain why balancing risk and reward is a very important part of investing. You'll learn the components of a balanced, meaningfully diversified investment program. And fourth, we'll talk about why discipline is so crucial to investment success. This is one of my most favorite topics to discuss, the discipline that's required to have good outcomes. And then finally, you'll learn today how you can build some momentum into your own investment plan. So, the core values that guide how we invest here at Northwestern Mutual really rely upon these 5 steps. We believe that expert guidance is invaluable when building your own portfolio, and that asset allocation is the foundation of any sound investment program. We believe the value of investment fundamentals, the principles, the truisms, like getting an early start, investing regularly, automating those investments, and using strategies that help reduce the impact of market volatility. There'll be some time at the end of our session here today for some questions. And if any of you would find it helpful, it'd be my pleasure to send over some common insights on investments, some question and answer kind of FAQ, if you will, and then some common investment terms as well that can help you feel more confident. You understand some of the lingo. Before we jump into it, I think this slide here is important. I want to talk a little bit about market declines. Why not start with investing, talking about the inevitable declines that exist in the market? They are the main reason why people shy away from investing in the first place. So think back to recent times when the market plunged. We've got a lot of experience with market downturn today and in the recent past. How did you feel when the markets turned down? Were you thinking sell every stock or mutual fund position, pull your money out, put it in something else? Or were you thinking maybe I'll wait and see what will come of this long term? Well, if you felt panicked, you're not alone. Market dives are unnerving. They are no doubt anxiety driving, to say the least. But there's one thing that we have to address. Market declines happen. And this is a look at how the markets have performed over time. You'll see that when you look at any individual single year return, there could look to be dips and plunges, meaningful dips and plunges. But the market was positive 74% of the time. So this look at the market from 1931 to 21 here is very indicative of how the market goes up and goes down. Now, this next slide, I think, can bring this into a bit of perspective. When we looked at, on the last slide, the individual years, remember 26% of the time there were down years. But over rolling 5-year periods, stock market returns have been positive 87% of the time. That's 13% more often than when you're looking at individual years. And while holding on to your stocks for the long term does not guarantee you any particular outcome, it doesn't guarantee you risk aversion. There is, over 15-year rolling periods, very encouraging data. So we've got that out of the way. Market declines are a given. But there are ways to mitigate the decline's effect on your portfolio. And the first step to a sound investment strategy is to actually get clear on your goals. Clarify why you're saving and investing in the first place. What do you want to accomplish? Is it retirement? You want to buy a beach home, save for education for kids or grandkids, whatever it might be. It's important to clarify that goal. And if you haven't really decided why you're investing, it's going to be difficult to know what you're really supposed to do. It's going to be hard to track your progress. So setting goals is critical. Let's say you want to buy the vacation home. If you just sit back and think about how great it would be to have that ideal place, and maybe, you don't think your chances are going to be that great because you're just sitting back and dreaming about it. Well, what if you actually put money to this goal? How much money will it take for a down payment or for the amenities you might want in this ideal hypothetical vacation home? It'll make it a lot easier to clarify how much you'll need to save and what type of returns you might need to experience in order to meet your goal at some future period in time. The more specific we are, the more clear, the better off we'll be. And I think simply identifying your goals brings your future into the present, and it'll help you know where you're heading as you plan to build this portfolio. And it'll help you stay invested through the ups and downs that can drive emotions over time. So your goals should be measurable. You need to estimate how much it'll cost to retire or buy that dream home. Your goal also needs to have a time frame. So we need to understand when it is you'd like to meet the objective. And, saving money for a particular objective becomes easier when we know how long we have for that money to grow and compound and how long we might need to actually use the funds for the objective. For example, college being maybe a 4-year time frame, retirement maybe being 4 decades. And if it's just a simple acquisition of a real estate property, it might just be a one-time event. So figure out what resources you already have, maybe in a 401k, a Roth IRA, an annuity, a stock portfolio. After you identify what you have, then you can start to think about the specific steps you'll need to take to reach your goal, like maybe increase your 401k contribution, maybe put additional funds into the annuity, whatever it might be. I think it's really important to recognize that your goals can change over time as your life evolves. And it's really important to revisit your investment plan regularly. All right. Next slide here is going to address risk as part of investing. There's no getting around the reality that markets can be risky. The more risk we assume, the greater and more handsome the reward. So investing is definitely not a no pain, no gain endeavor. And that's why this second step towards building a sound investment plan is so critical. It's all about protecting yourself against risk when you can. And when risk is inevitable, as it is with investing, knowing how much volatility you're really willing to take on. So risk management, a really nice place to start here on goal number 2 as part of building this portfolio. Car accidents. roof leaks, medical issues, disabilities. There's all types of ways a wrench can be thrown into a financial plan. No matter how strong your investment strategy, you have to stop and use those invested funds for something else when life throws a curveball. And that's going to affect your ability to reach your investment goal. So if you can start investing with knowledge the dollars you're putting into action are specifically and solely for that investment objective, then you'll have a much smoother approach to meeting your goal. So, for example, if you're injured and didn't have enough or proper medical insurance, or you didn't have enough in an emergency fund, you might have to pull money from a 401k or a like retirement plan to pay for the unexpected bills. And when you've recovered, you have to build those funds up again just to get back to where you were before life threw you that curveball. So that's an example of why you really want to make sure that prior to investing, you've considered risk meaningfully and have really checked the box on risk mitigation and those other factors of life that could potentially offset your investment goal. So get insurance to cover risks that you're able, and then build a solid emergency fund of cash that will protect your investments, because you don't have to liquidate investments when you need cash. Instead, you've got the wealth in that emergency fund already accessible easily with liquidity to help you endure what life might throw your way. Combined, these create a really good foundation and a sound start to any investment strategy. Anytime we're investing, there's risks involved, and there's nothing that's a sure bet. But it's important to know your risk tolerance could be different than mine and that of your neighbors and that of your colleagues. It's okay. There's no right or wrong level of risk. It's just all about you uniquely and your time horizon, and you really thinking critically about how you'll feel if the markets turn down. Will you panic, or will you recognize that to be a natural part of investing and proceed with the investment policy that you started with? So at Northwestern Mutual Wealth Management, we use a personal investor profile. This helps investors understand how they themselves uniquely feel about risk. And it looks at important factors like your investment time frame. That is how long you'll be investing before your money's needed. It'll look at when you're ready to start using those funds, how long you'll be making withdrawals. This is the withdrawal time frame. And then how much of your money is already in whole life insurance, pensions, 401ks, personal savings, and the like. These are usually considered more stable assets that you have already established that could be utilized towards the goal. And then there are other questions that the investor profile can help with, like figuring out your personal liquidity, the stability or volatility of your income, and how you personally feel about market volatility. How you answer the questions on an investor profile will help you start to clarify your risk tolerance, and then will help you make good decisions around how to build a portfolio unique to you, such that the portfolio is really aligned to your risk preferences. Okay, so knowing how much risk or volatility you want to accept is a big part of the picture, but it also helps to recognize that the returns of the equity or stock market look a lot less volatile when you view them over long periods of time. You might remember on a few prior slides, we addressed that the longer the time horizon, the more favorable the results. And that's because over the long term, the periods of high returns offset the periods of lower returns. So look at this chart. It shows how the S&P 500, the broad-based domestic stock market, has performed each decade for the past 7, since 1950. And if you look at each decade separately, there are a lot of dips, but in 70 years, The S&P has ended the decade with a negative return only once, and it was positive again the following decade. So the trend is for the market to increase on a permanent continued advance. And you can see that even though the market does drop at times, staying invested over the long term helps you create better outcomes. So when you're thinking about investing, the longer the time horizon, the more risk you're likely able to incorporate into the portfolio. Now, we've talked about two important steps. The third step is linked to risk, as we just discussed in the last step, but let's talk a little bit more about diversification to give you proper understanding of why clients that we serve always diversify their investments. In today's world, investors have a huge number of options to choose from. There's different assets and investment vehicles and account types, all available from hundreds of financial service providers. Where you invest your money depends on what you're trying to achieve, your risk tolerance, how long you're investing, and what investment options are available to you. I believe it to be important for anyone to diversify. And what that looks like is splitting up your money into different investments in different asset classes so that your eggs are not all in one basket, so to speak. Finding the right combination of investments to meet your goals in a way that's suitable for you, given your unique risk profile. Asset allocation is a term often used that I want to help define. It's actually exactly what it sounds like. It's how you allocate your assets or split them up between funds or different asset classes to create the diversified portfolio that's suitable for you. It does not need to be complicated, but it should include at least two asset classes to be effective. And that's because each asset category has something very unique to contribute to your long-term investment performance. Risk, reward, and stability, to name a few. Equities are typically the most risky, but they offer the greatest long-term growth. So think about stocks as having the highest level of risk, but the highest returns. Now, fixed income or bonds, these securities positions have other benefits and detractors as well. Bonds are a good choice for income, while cash alternatives like money market funds can provide liquidity and stability as compared to other asset classes. Money market funds are designed to preserve the wealth that you input into the fund. So when you start to mix between cash, stocks, and bonds, you're building into your portfolio with purpose a large, broad basket of investments. And the benefit is that you'll never have all losers. But to that point, you won't also have all winning investment positions. And that's at the heart of diversification. So broadening your asset allocation is simple, but it can become more complex as we start to look at the sub-asset classes. So when we think about stocks, well, within the realm of stocks, there are international stocks, domestic stocks. There are stocks in very well-established regions of the world. There are stocks that are available in emerging markets. And there are small stock companies, large stock companies. There's all different types of complexities that might make it seem overly complex, but that's why I think it's super important to align yourself with a sound investment firm with advisors that understand you to help you build in those extra layers of diversification when appropriate. So we're going to now address models, asset allocation models. And when markets go through a rough patch, there are always people who say they lost a lot of money, they lost their confidence, and they're just distraught and they never want to invest again. But then there are others that seem to get through that downturn untouched. And we might wonder, why is that? Well, it's not just that some investors are lucky or that they have a secret sauce. The investors that do well understand the benefits of diversification and would likely have implemented a strong asset allocation where they have the proper allocation to equities, to fixed income, to cash, and then to additional sub asset classes as appropriate. I think combining these asset classes will help you smooth out your returns. That will help instill more confidence and allow you to persevere through the challenging times. Bonds can be totally different in correlation to stocks. That's another reason it's so important to build a portfolio with both stocks and bonds. And what you'll notice on this slide is that even the most conservative portfolio has some stock exposure, and the most aggressive portfolio has some bond exposure. It's all about finding the right asset allocation percentages for you as a unique investor. This I call the quilt. There's a lot here on this very colorful chart. This is interesting. There are clear advantages to diversification and asset allocation, and I think they're mapped here on this chart. Often, many prospective client portfolios represent a hodgepodge of investments based on hot tips or the prior year's best performing asset class, rather than a portfolio that's rooted in clearly defined goals or strategy or investment policy. If there was one asset class that led the market every year, building a portfolio would be easy, but the markets are changing all the time, making it impossible to predict which asset class will perform the best or worst in any given year. So each color on the chart here represents a different asset class. And some look really good. Look at the bright red, which represents international emerging markets. This has been at the tippy top 4 times from the period here of 07 to 2021. But look at where it shows up the rest of the years. It's pretty unfavorable. There's a lot of volatility when you invest in just that one asset class. It was at the absolute bottom in 08, 11, 2018, and in 2021. Now, it was second best in 2020, but second worst in 2013 and 2015. That is going to be challenging to own because it's going to be a roller coaster ride. A lot of gut checks will exist if you exclusively invest in that one asset class. So how is it that we want to build a portfolio? Well, if you look through this chart and you look at the white box, this is a diversified portfolio that we've been talking about. And you can see it's a pretty solid performer all the way across. And that's because it's not relying on just one asset type. This is a 60-40 hypothetical diversified investment portfolio with 60% of the exposure in stock and 40% in bonds. That's what we might consider to be a balanced investment portfolio. Not super aggressive, not super conservative, sort of right down the middle. And of course, diversification means that all of your investments won't be the best performers. I already mentioned that, but they won't also all be the worst either. And developing a balanced investment program will help you reduce the volatility that could totally throw you off course. Okay. Step 4 of 5, discipline. This I mentioned is one of my favorite topics because it can be the hardest for some people. Engineers like you guys understand that math is math. There are sound principles that always work. And often it could be human error that might make a job fail. Well, when we think about investing, the discipline is really all about making sure as human beings that we don't allow our emotions to drive decision making. we need to rely on those truisms, on the principles that we know work, some of the hard facts around investing. So we talked about timing the market not being a great strategy, but it's not surprising that investors still try and they make these emotional choices. They're jumping in and out of investments in the hope to get the best returns. Now, no one wants to lose money, not even in the short term, but take a look at this slide. This shows how missing the best trading days in the stock market over a 20-year period actually affects your returns. So if you invested the entire time over the 20-year period, you had almost a 9.5% return. Not bad, right? Well, if you try to time the market, as so many uneducated investors do, then you're going to end up having a much less favorable outcome. And if you miss more than a couple days, you could actually lose money in the same portfolio. So it's about staying invested and staying the course and aligning your outcomes with the investment policy that's suitable for you. So there's large up and down days. They tend to be clustered. And when one tries to avoid a market dip, you could easily miss out on a great day. So recognize the impact of staying invested in the long run. Forgive me here. I stepped ahead. Here we go. Okay. Compounding. This is crucial. When we're disciplined, we allow the market to do what it does, and we can benefit from compounding. And this is really when your assets earnings are reinvested into your portfolio, which means you're earning interest on interest, and it can make a huge difference over time. It's our best friend. When we are leveraging compounding in our own favor, it can be awesome. The graph here shows how much you need to invest each month in order to have $1 million by the age of 65. So here we're assuming 7% interest rate compounded annually. And it's important to note that these numbers do not include any taxes or transaction costs. So this is hypothetical here. But if you started investing when you were 25, you would need to invest $381 a month to get to the $1 million mark by 65. And that's a total investment out of pocket of 182 grand. Now, same scenario, we just wait 10 years to begin investing. And instead of being at 25, you start investing at 35. You would need to more than double that monthly contribution to get to the same $1 million mark at 65. You would need 820 per month. Now, look, these are all based on real figures in this example. This is simple math. And you would have a total investment out of pocket of $295,000. That's a lot more money. This shows clearly, numerically, the benefits of compounding your investment portfolio. So the difference really exists when you start earlier. You're allowing the interest to earn interest on that interest and compound. And the more time you give compounding to work its magic, the bigger the difference. Okay, step 5. It's simple. Let your investment plan build momentum. So think about this. How many of you exercise? It's a struggle for me, I know. Although I did have a personal best on my Peloton this morning, which I'm quite excited about, it's always a struggle, particularly when I haven't worked out. And the longer you stay away from exercising, the harder it is to get back into that rhythm and create progress. We're coming off the holidays here. It's been a real struggle for me. Let's relate this now to investing. The more we're investing, when we automate investing and we're doing it on a proactive basis with purpose, we start to feel much better about our efforts, and we are able to keep investing even though there are changing market environments. So let your progress build on itself. Reinvest the investment earnings so that we can benefit from compounding like we just discussed, and create some momentum. When you allow your dividends and interest earned to compound over time, you're building more investment earnings. That's that interest on interest idea. So income producing investments are key to the approach here. They help you keep your investment plan on track, even during market declines. Think about that. Historically, many companies have kept paying dividends at the same rate no matter what market environment exists. So bonds and money market funds also do provide some steady stream of interest payments, which can help cushion your portfolio during periods of market instability. Reinvesting your income is key towards boosting returns. That's what we care about. Long-term investment outcomes, the returns. And this chart here compares the hypothetical growth of $1,000 invested in stocks and bonds over a 20-year period with and without reinvestment. So reinvesting allows you to capitalize on this compounding, which means you're earning income on the principal investment in addition to the reinvested dividends and coupon payments or interest payments that you've received. And if you compare the stocks with reinvestments to the stocks without reinvestments, you can see that your returns on that $1,000 are about 2% higher if you reinvest. That is powerful. So whether it's stocks or bonds, reinvesting dividends and interest can help maximize the growth of your portfolio. Now, I want to move on here to a recap of the 5 steps that we've covered here to help you stay on track, gain more confidence in your investment plan, despite whatever the market decides to be doing. I know we've covered a lot. So step 1, and as a refresher, start with your goals. Write them down, be specific, quantify and clarify as much as you're able. Step 2, protect yourself against risks where you're able. And know yourself as an investor. Start to really get clear on how you'll act when times get tough. Understand the role that risk plays in helping your investment strategy. Step 3, build a balanced, meaningfully diversified strategy. It'll help smooth out the bumps when they come your way. 4th step, give your investment plan time to work. Stay strong in the face of market volatility. Don't allow what's occurring in the short term to affect your long-term investment policy. There's always going to be something in the news and the headlines and the economy and you name it. There will be factors that influence the markets, but they are typically very short-term in nature. So give your investment plan the time it needs to work. Finally, let the momentum build. Strategies like compounding and reinvestment of your dividends and interest earned can help you speed up your way to your goal. In closing, I'll suggest the value of professional guidance to be so critical because of all the noise out there, right? You turn on the TV and it's a doomsday scenario, seemingly at any given time, right? It's clickbait when you're going on to certain sites and looking at the news. It can be very anxiety focused and it's all about attracting attention. But when you start to think logically about the markets, as we have here today, and you start to implement some discipline and momentum, then you can endure those downturns and you'll come out on the right side, making the right choices to get you to your goal. So working with a financial professional will help. Someone in your corner there to help you through those tough times. In my career, I started in 2009. We've had some downturns in my experience, and it's been influential, to say the least, to be there for my clients when, if I wasn't, they might have completely derailed their financial progress by selling low or letting their emotions really dictate their actions. We want logic to be the sound factor to our decision making. I think hopefully this puts some of the sound investment principles into perspective for you so that you can maintain your focus during times like today where we have a lot of volatility and market turmoil. Northwestern is a phenomenal firm, been 165 years here helping clients nationally, and we're one of the most favored broker dealers. We're fiduciary investment advisors here, and it'd be my pleasure to commit to serving any of you that have interest in our work. Don't hesitate to ask some questions here and reach out to us off base. It'd be really great to connect, and I'm sure we can give you some good perspective going forward. So let's open this up for some questions.
Fantastic. Thank you so much, Kyle.
Sure.
So, Kyle, before we move on to some audience questions, I do have a couple of questions of my own that I'd like to ask. So, my first question, when should one start looking to invest and how much money should be put up front?
Good question. The short answer is sooner than later, particularly because you'll benefit from compounding interest. You'll have to save less to get to the same outcome the sooner you start. Mm-hmm. And I would think it to be a very smart and practical practice for anyone to track their cash flow. So think about your expenses and track them, what it might be for rent or mortgage, cell phone, groceries, vacations, gym memberships, you name it, add them all up. And on an average month, determine your outlay. What does it take to operate your lifestyle? And compare that to your average income. Save and invest the difference.
Fantastic. Thank you. My next question is a common one that's probably, or one that's probably common with most people these days, especially younger people going or getting out of school or having just graduated. What would be a bigger priority? Paying off there was supposed to be loans in there. Paying off student loans or starting early on investing?
I think it's about striking the right balance. Here's the deal. If you solely focus on debt reduction, one day you'll be out of debt. Maybe 5, 10, 15 years down the road, you can high five yourself and say, I completely eradicated that loan. But if you've solely focused on getting rid of the debt, simultaneously, you'll say, now I'm starting from scratch on actually amassing wealth and building capital. And if you solely focus on building wealth, then you'll probably wake up one day and feel like you did yourself a disservice because you have this ongoing loan that might be compounding. Depending on the interest rate, it could be really unfavorable. So finding the right balance based on your interest rates on the loan, your risk preferences with regard to savings and investment, I think that's going to be key in helping anyone determine how much they should allocate towards wealth building versus debt reduction. But in short, don't focus on just one. Make sure that you're striking a balance between the two objectives.
Gotcha. And then you can probably apply that advice to any sort of loan that you might have, not just student loans like mortgage and everything, correct?
No, that's a really good point you bring up there, because the rate environment we find ourselves in today is much higher than it was just a few years ago. And it really depends on what the rate is. What type of loan you have often dictates what type of rate you'll have. Credit card rates are typically much higher. Student loans would be less, and mortgage rates, depending on how you qualify, could be even lower than those rates. So, we think that making sure you evaluate the loan type and the interest rate, we think that's going to be a valuable contributor or factor to you getting to the right solution for your own circumstance. So debt isn't all bad, particularly low interest debt. that you may have secured over the past few years when rates have been really low. And in closing on this topic, I'll suggest rates are still reasonably low compared to where they've been historically. So debt can meaningfully benefit individuals. It's just got to be well managed.
Gotcha. Fantastic. Thank you so much. So we'll move on to our first audience question. Audience member Sachin, I hope I'm saying that correct. When you say visit your investment plan regularly, which you did during your presentation, I'm thinking rebalancing the portfolio. Can you illustrate 3 to 5 indicators that should guide rebalance? And do you have any examples?
Yeah, so I appreciate this question. Visiting the investment plan regularly is super important because the market is moving daily. And when we discuss rebalancing, what we're really getting at here is reallocating the exposures within the portfolio to the original target measure. And when the markets move, so might the exposures to different asset classes within any given portfolio. So to ensure that risk is properly managed and aligned with the individual investor's circumstances, we rebalance and make sure that we're never allowing the portfolio to shift to become a portfolio that is no longer suitable for that individual client and their risk profile. Now, often rebalancing can benefit investors because we end up buying low and selling high. So when the markets move and a particular asset class has outperformed, we might have an overexposure to that asset class and we trim it back to the original target, selling high and then reinvesting low. That is a really nice, sound way to build wealth over time. To think about the last bit of that question, indicators that would guide rebalancing, we would think you would want to make sure that if your portfolio is more than 4 to 5% under or overweight in any particular asset class, it might make sense to rebalance. Now, that is case specific, no doubt. You have to look deeper, but generally speaking, at least as it relates to risk management, you don't want to have more than you should in any given asset class.
Got it. Thank you. Sachin, hope that answered your question, and thanks for sending in that question. This next comment from one of our audience members, an observation. You seem to have ignored the fourth major asset class alternatives, including hedge funds, REITs, private equity, commodities. Can you comment on this? Any insight on that at all?
Yeah, absolutely. So we enjoy the use of alternatives, particularly for our larger net worth clientele. Here's why. Alternatives are illiquid. So these hedge funds and private equity type investments often tie up your wealth. There's a lack of liquidity, and it takes the right type of investor to be able to withstand the illiquidity that comes with these alternative investments. So in fact, there are regulations that mandate a particular investor to have a specific level of wealth before they're even eligible to invest in some of these alternatives. Now, for the clients we serve that do have access because of the amount of wealth that they've amassed, these can be really, really awesome ways to further diversify a portfolio. For example, hedge funds don't necessarily move in the same direction as the market. That's a nice contributor to diversification within any investment portfolio.
Thank you for that insight, and thanks for your question. Larissa asks, for a complete beginner in investing, are robot advisors a good option?
That's an interesting and somewhat loaded question. I do appreciate that. Let's face it, at some point, we were all beginners. And just because we're new to something, that doesn't mean we want to assume we should take a particular approach. I suggest any new investor be open-minded to what's possible. Evaluate the prospect of a robot advisor. Evaluate the prospect and value of a human advisor, and then maybe consider doing it on your own. And I think if you go through that process as a new or even experienced investor, you'll come to a very similar conclusion that having someone who understands you uniquely, your unique fact set, your financial picture, your goals, that's going to create some benefit. So I like the personal touch of a fiduciary investment advisor that is a human being. And I think that while there is some value to robotic investing, the truth is that holistic wealth management, comprehensive wealth planning comes with factors that need to be considered far beyond what any robot advisor might consider.
Great, thank you, Larissa. I hope that answered your question. Actually, we have another follow-up question from Larissa. She asks, being a non-US citizen, is it a smart move to invest in the US for long term, though she may physically relocate to another country?
I really appreciate that question. And I think that your question is actually getting at the heart of diversification, right? Where we invest matters. Historically, investments in the US have done very, very well. And global investing can also be a great contributor to investment success, but we need to evaluate the type of international investments that we might be making. So, regardless of your physical location, it's my encouragement that you diversify and include both domestic and global stock exposure in your portfolio.
Larissa, I hope that answered your question, and thank you for the great questions. This next question from audience member: what is a reasonable rate to pay a financial engine?
I have to be honest, I don't quite understand the question. I'm not so sure what a financial engine is. I would imagine that could be somewhat of a robot advisor. Look, I think it's like anything. The more we desire in value, the more we're going to need to pay. So there's a real reason there's a difference between, staying at a super fancy hotel and then your normal humdrum hotel. There's a difference in the price because you're expecting a better experience and more value the more that you pay, and you will get that. So I think it really depends on the individual and what type of service and value and experience they desire.
Great insight. And to our audience member, if you need a little bit more clarification or a better answer, if you could clarify what a financial engine is, so that we can better help you. But thanks for your question. And Kyle, I think that's it for audience questions so far. While we still wait for some, I do have a couple more that I'd like to ask since we still have a bit of time before the end of the hour. And you might have gone into this a little before with my last question. How much of my income should I be investing? Let's say per paycheck.
Yeah, that's a good question, and I appreciate your desire to quantify the numbers. There's a good rule of thumb. It's not applicable for everyone, but the rule of thumb suggests you should be saving 20% of your income. So typically 60% or so of your income is on essential expenses, housing, food, and the like. 20% of your income can be on discretionary expenses. So vacations and gifts and the fun stuff that's nice to have. And then that last 20% ought to be saved and invested.
Gotcha. Thank you. And all right, so we have a couple more questions and comments. One from Lynn Coblin. Lynn, glad you could join us. Kyle, could you define fiduciary?
I sure can. It's a great request because there's a stark difference between professionals that have a fiduciary standard and those that do not. The fiduciary standard essentially means that the advisors must operate in the best interest of the client at every given moment. And that's important. Here's why. If you don't have a fiduciary standard of care that you're mandated to uphold, you simply need to make sure that any investment recommendation or financial planning strategy is suitable at time of implementation. So long as it makes sense today, that's good enough. But with a fiduciary standard, the investing has to make sense today and at every given point going forward. The client's interest needs to be considered and met regardless of where we are in the market or the economy. So it really boils down to making sure that the interests are aligned and that a fiduciary is there to serve the interest of the client.
Thank you so much. Next question from Daryl. You haven't mentioned anything about crypto. Would you say investing in crypto is something worth looking into, or any thoughts on that?
Yeah, this is really great to hear this question. Not surprised to get it, although the crypto craze has somewhat dialed itself down. Look, there's likely some great options in crypto. The reason we do not recommend crypto investing to clients is because it is, as you well know, very unregulated.
Hmm.
There are all types of phishing scams and a ton of risk. Um, so the decentralization leads to no regulation and a lot of risk without any proven track record over periods of time. So while there may be some benefit to including crypto into a portion of your portfolio, most of the tried and true investment outfits in the states here are straying away from those investments because of the risk and the lack of regulation.
Gotcha. Thank you. Yeah, crypto is always a hot topic, but as you mentioned, it's unregulated and a lot of stuff. This next question from Pradeep. I hope I'm pronouncing that right. In simple terms, what's the difference between value averaging and dollar cost averaging, and what is better for a disciplined investment?
I appreciate this question, but I should suggest that I don't know what value averaging is. It might just be that we're not aligning on the particular term, but dollar cost averaging is a very strategic way to put money into the market. Essentially, dollar cost averaging is committing to putting money in regardless of the valuation of the market on a particular day. So we're not timing the market. We are proactively investing on, say, the first of the month every month, or at the end of the year every year, regardless of where the market is at that time. That's going to create really good outcomes, and it builds more discipline, I would say, as to your question on the investment portfolio. If we're less worried about timing the market and we're more disciplined about just getting money in, we're going to have better outcomes because no one can consistently time the market, and it's much more of a fool's errand.
Got it. Thank you. Pradeep, hope that answered your question. So Kyle, I do notice that we have a few more questions, which we may not get to by the end of the hour. Would you be able to stay about 5 minutes
Yeah,
afterwards?
I can do till about 5 after 3 here, Eastern Standard. And we typically get a lot of questions whenever we do these types of presentations because there's so much that goes into
Hmm.
investments. And it's my encouragement that anybody who's participated here, reach out to me off base. I know you all have my contact information, and we can schedule a few minutes to catch up on a call. It would be my pleasure if we don't get to your questions today.
Fantastic. And thank you so much to our audience for your great questions. We'll try to get to as many of them as we can. This next question, Joseph asks, what are the typical financial advisor fees, dollar amount, percentage? I would imagine it varies depending on years of experience, but any insight into
Yeah,
average?
this is a really good question in that I think it gets at two different topics around fees. What is my fee based upon? Meaning, am I paying a flat fee for advice, or am I going to be paying a fee for ongoing investment help and consultation? So, on average, I haven't looked all that lately, but I think the average investment advisory fee is probably somewhere around 1% to 1.5% of the overarching portfolio. And I think, as I mentioned earlier, the more value we want to derive from the engagement of any financial professional or financial firm, likely the higher that fee will be. So there are certainly firms that might charge more than 1.5 or 2 or more. And there are some firms that charge less. And it's the case you get what you pay for. Fees are important, no doubt. So it's critical for you to understand what you would be paying and what you are paying for, particularly.
Fantastic. Thank you. We have two final questions. First question, Larry asks, can you discuss tax bomb when investing in a standard 401k and IRA opposed to a Roth retirement investment?
I can, yeah. The tax bomb lingo always makes me smile, but it's a reality. Look, I think what the question gets at here is the difference between the way that wealth is taxed in retirement. So 401k and IRA dollars, these are all taxed. Every single dollar that you withdraw is taxed at your ordinary income tax rate. Further, we are mandated to withdraw from IRA and 401k account types. Whether we want the money, need the money, it's irrelevant. You must withdraw when you reach the age of required minimum distribution timeframe. And when you withdraw, you have to pay tax on every single dollar. Now, that can cause some issues. And if we compare that to Roth, as notated here in the question, there are no requirements to withdraw from a Roth account. That's really powerful because you don't have to pay unnecessary tax. You only will be taxed with the IRA and 401k type money when you withdraw as compared to the Roth. And there's a lot more that goes into it, but in short, when you have a need to pay taxes on dollars that you don't even need to live your lifestyle, it can be a big factor in contributing to that ticking time tax bomb that I think he's referring to. I hope that was helpful. There's a lot more there on the tax side of it, but
Gotcha.
the Roth and IRA type differences are pretty stark.
Gotcha. Thank you so much. And thanks for the question, Larry. Final question from our audience. Armin asks, what is the right bond in taxable account to diversify ownership of a company stock?
There's a lot in that question. I would suggest, I'm not sure I fully understand the heart of the question, but the taxability of investments is a key, crucial consideration. And if we're looking at a portfolio that is taxable, we are going to recommend as fiduciary investment advisors the most tax efficient assets possible. And that assets in that taxable portfolio will be different than if we were managing a tax-free portfolio or tax-deferred portfolio. So there are asset classes and securities types that make a lot of sense solely in taxable accounts that wouldn't make sense in a tax-free account. So more to come on that if you want to catch up off base, but you're hitting an important point, which is, you know, you guys have covered fees and taxes, and really I think the taxation's the most erosive element to any wealth building effort. So taxes are where we want to be spending a lot of time, because that's going to drag income and earnings and investment outcomes meaningfully.
Gotcha. Thank you. Unfortunately, folks, we are out of time. I know we could go on and on about this. This is a huge topic.
Reach
Kyle,
out
thank
to me off base. I mean it. I mean, we're here to help. And if we can schedule some time to catch up, we might be able to give you some good insight that's relevant for you and your unique questions.
Yes, absolutely. And we will forward Kyle's contact information to all of our registrants. Kyle, thank you so much for joining us today and providing our audience your expert insight into investment strategies that I know they'll be able to help them set up for financial success. Really great having you today.
Thanks for having me. It was a pleasure.
And to our audience, our next webinar in the financial literacy series, in partnership with IEEE member discounts, will be on Wednesday, February 8th at 2 p.m. Eastern. The registration link has been provided on the screen below. Excuse me. Sorry, give me one sec. We'd also like to mention that IEEE members can take advantage of exclusive and discounted pricing on insurance and a variety of products and services that can add up to substantial savings. Discover what IEEE member discounts can offer you through the link provided below. Thank you, everyone, for attending today's live stream webinar. Please don't forget to like, share, subscribe to our channels on social media, and check back daily for future live stream updates. Have a great day, everyone.